This week, we have been looking at whether the U.S. is becoming more like Japan with a low-growth lost decade. The series would not be complete without former Fed economist Richard Koo. He has written a book and testified before Congress on the lessons from Japan's Great Recession. He is now the chief economist of Nomura Research Institute. He is in Taipei this morning. Richard, thanks so much for joining us on the Inside Track. Based on the data points, the economic data points we've gotten in the past month, how likely is it that the U.S. is heading towards a lost decade? Is it more or less likely than what you told us about 4 to 6 months ago?
Well, it is beginning to look more like Japan. The amount of house price declines, the commercial real estate price declines, they are all following the Japanese pattern very precisely. And very slow GDP growth, even with all this monetary easing, QE2, possibly QE3, suggests to me that United States is going through the same process, what I call balance sheet recession, that Japan went through 15 years earlier.
You mentioned the possibility of QE3. What should Ben Bernanke do today in his speech, and then what should he do as a follow-up action?
Well, actually, the Japanese experience told us that when private sector is minimizing debt or deleveraging with very low interest rates, there's very little monetary policy can do. In fact, Chairman Bernanke has been saying since the middle of last year that this is no time to cut budget deficit. The fiscal stimulus should be in place, because I think he also understands that under the circumstances, there's so little that monetary policy can do, but there's a lot the fiscal policy can do to keep the U.S. economy from losing its bottom.
Richard,
so I think he should continue to push that line. Yes.
Continue to push that line and maybe try to subtly encourage Washington to take a little bit more control. Sounds like you think that Congress should do something.
Yes, because when people are deleveraging, even with zero interest rates, that means they are very sick. The private sector is very sick and in need of help because their balance sheet's underwater. And when that's the case, even if Federal Reserve lowers interest rates, put liquidity into the market, private sector cannot really respond because they have balance sheet problems. And the government cannot tell the private sector, don't repair your balance sheets, because private sector must repair its balance sheets. So the only thing the government can do is to spend the money that private sector has saved and put that back into the income stream. And that's, I think, is what U.S. has to do. And that means this is no time to cut budget deficit. It has to maintain the fiscal stimulus until private sector is healthy enough to start borrowing and spending money again. And at that point, Federal Reserve will become all very relevant. But at the moment, I think the control of the U.S. economy is really in the hands of Congress.
Richard, with 9% unemployment, there are many, many people who would share your view. Thank you so much, Richard Koo, joining us there from the Nomura Research Institute, where he is the chief economist.